Hello, everyone, and welcome to episode 8 of the Reinsurance podcast. I'm your co-host, Jared Lee.
And I'm Ben Rose.
Good to see you, sir.
As always.
Back.
Good to see you as well.
Thank you.
I was just having a laugh to myself because I've thought of a tangent with which to begin the episode because it's my favourite part of every episode where we start with a silly tangent. And what I realised was that tangent is actually a mathematical term. I can't remember exactly what it is, but it's it comes in there with like angles and segments and things, right? It's a very particular mathematical term, and it reminded me of a funny story about something you and I did in our consulting days.
Okay.
After we worked very hard on reinsurance strategy, which is what today's episode is about. And quite frequently we would end up in the office until gone midnight working on all sorts of problems, and occasionally this led to total lunacy and delirium to the point where I wonder if you've worked out where I'm going with this.
I think I do. Yeah.
But Jared and I ended up posing some really strange sort of philosophical and mathematical questions to ourselves. And one evening we tried to work out something. Do you remember what it was?
Yeah. So I don't know how this originated from. I don't know what process by which we started this quest.
We were talking about Minnesota and a slight slope that walked up to your old school or your old university.
Oh, yeah. So I went to the University of Wisconsin-Madison, and there's this main hill in the center of campus where the one of those primary buildings is, and it's called Bascom Hill. And it's relatively steep, and what we are told, and I think this is true, is that if you walked up it every day for a semester, it would be the equivalent of climbing Mount Everest. And this is like an interesting fact to tell Ben at 9:45 at night on a Tuesday. And then we went into this tangent of, if you just built a gradual slope up Mount Everest, like how long would that be, or how would it take? Like how long would it take, or how much material would it require? And we spent like ages on this.
Yeah, it was very funny. And unfortunately, I don't think she listens, but my mother is a maths teacher, and she'll be incredibly disappointed to hear that not only have I forgotten what a tangent is, but also neither of us could remember how to do trigonometry properly, which was really funny. We could just about work out how to do Pythagoras and all that sort of thing, but when the sines and causes and tans all came into it, we're like, so wait a minute, how do we do this again? We've worked out the angle of the slope that's required. And we were trying to work out.
I like how you zigzag. You go around. You sort of zigzag back up and
or
back
start
and
really
forward.
far away. How do you minimize building material? It's going to be really expensive. How do you preserve the natural beauty of the thing?
Yeah.
Could you do it an interior ramp that goes round and round up the inside?
Yeah.
It's a real problem. If you have any ideas for how we can build this gentle ramp to make Everest accessible to all, we'd love to hear
now it's
them.
super crowded, isn't it? People go up by the thousands, and it gets like these like congestion. Like when you watch videos of it now, it's mental.
Yeah.
I think we ended that being like, what if we built an elevator from within the center that just went straight to the top? Yeah, it was a late night, literal mathematical tangent in our consulting days.
But it's good. I think when you're doing reinsurance strategy and this sort of thing, you've got to open your mind and spark new ways of thinking as you try and work out the way forwards, and that was what we were doing, expanding our minds.
Well, and exactly. And I think we'll have some other conversations around sort of the nuance of this strategy and talk about things like Porter's forces and all manner of other things. But at the end of the day, I think insurance and reinsurance are businesses like any other. So when you look at the strategy, it's how do they make more income? In that case, it looks a lot like premiums. And how do you do so effectively, which is reducing claims and writing good business, and sort of minimizing expenses and growing the business. Sort of like it's all the sort of component parts of any business. It's just a business of taking on risk and sort of balancing out what that looks like in it.
Yeah, absolutely. And I think the basic Porter version of this would be the demand is for some reinsurance, basically. Mm-hmm. And so the rivalry at the center of this with all the alternatives and substitutes happens around what we think of as a reinsurance company, with some substitutes, and alternatives like alternative capital, etc. But this intense rivalry is between companies that call themselves reinsurers. And I think that's going to be the focus of today's episode, really, is to talk about what is a reinsurer? Where do they come from? Where do they go? Where do they come from?
Cotton Eye Joe.
Yeah, exactly. But basically, yeah, I think that's where we want to go today is to really understand, like, where do reinsurers come from? I'm going to say it again. How do reinsurers start? Like,
Yeah.
Why do they even exist in the first place? Are they all centuries old? What leads to reinsurers coming to life?
Yeah, I think it's when you look at we talked really in an earlier episode about in the reinsurance category existing and then retro existing, and there's always this additional level that you can sort of source, and the demand exists when insurance companies are being established and they realize that holding all of this on their balance sheet is risky, and they want to find some way to help them offload that. And it originates very much kind of organically in that sense of like, oh, well, we'll spin up an entity that takes on your risk, insurance companies, and then they build sort of a natural diversification model there. But originally it would have been very, and you can see this in the sort of history of reinsurance, but the original companies looked very much just like traditional insurance companies, but just built to understand the risk of a portfolio of insurance companies, or really large complex risks that an insurance company wanted to offload parts of. But it's evolved quite a lot since then. But the core was just an insurance company with a different client target, essentially.
Yeah, and I think maybe it's worth touching on a concept that's very central to insurance and reinsurance, which is hard and soft market cycles. Mm-hmm. So the way demand and supply works in the industry is typically governed by what the availability of capital is at a particular given time and for a particular type of coverage that's desired. So what often happens is at some point the demand for reinsurance coverage will be higher than the supply. Mm-hmm. And that's what tends to give birth to new reinsurers. Yeah. Because you end up with like we need reinsurance. We've got all these insurance policies that we want to cover or we need to write, but we can't actually retain all that on our balance sheet. We need support. Is anybody out there who can? I wanted to do an echo then. Is anybody out there? out there? I don't know what that's from anyway. And this often leads to some bright spark in Bermuda or similar going to a private equity house or similar and going, there's demand for a new reinsurance company, and if you give us a bunch of money we can set it up and charge really high prices, because in a hard market you can charge higher prices because there's a limited availability of suppliers. In a soft market, the opposite, you have too many reinsurers, and actually we're coming out of what has been termed a sustained soft market cycle for quite a long time. So due to I think a general interest rate environment and sort of background economic environment for a while where it's been really hard to get decent returns on anything in the world. A lot of investment has poured into the insurance and reinsurance industry because it's seen as a non-correlating asset class, basically, where if there's a financial crash, we have the financial crisis of 2008, etc. To some extent, the insurance and reinsurance industries are insulated from that. Not entirely, but quite a bit, in the sense that whether the wind blows or not, whether earthquakes happen, whether sinks ship, that's not typically due to prevailing economic conditions.
Right. Right. Well, and I think when you look at sort of the history of the space, you've seen what are called kind of like classes, right? And as you said, it's driven by market conditions and following historically really large events like Andrew and Katrina and stuff. You'd have these emergence of, well, all the reinsurers paid huge amounts of claims for those things.
Can you just clarify who Andrew and Katrina are?
Two very poor
individuals. Katrina? I thought it was Cordy. I changed the podcasting team.
Yeah. Hurricane Andrew, Hurricane Katrina, which had devastating effects across, insurance companies and their reinsurance backers. But the result of those events sort of hardened the market quite significantly. And you saw like an emergence of underwriters, oftentimes in Bermuda, sort of to service and provide capital for this sort of spike in demand that was no longer being filled. The reason I think we saw this soft cycle for so long was there was so much capital that when we'd seen the sort of Irmas and Harveys and all these events more recently, none of them really rattled the market where it had an outsized impact on that supply. right? So even though people were paying claims and stuff, no one was going out of business. No one was sort of closing up shop and taking, their capital elsewhere. The interest rate environment wasn't such where they're like, well, we'll just move to a different asset class. So there was so much capital still sitting there that it didn't spark the sort of new classes of 2020 or anything like this. We're starting to come out of that environment a little bit now, and there's rumors of interest rates changing and things, which I think will, again...
You heard it here first.
Yeah, exactly.
Buy, sell, something, advice. No, we are not advisors.
Do we need to have like a blurb like, this is not please do not take our financial advice on this podcast. Yeah. But I think that's, and you get these firms are getting much, much larger. I think, you look at companies that originally set up following, Hurricane Andrew or Hurricane Katrina, were much smaller in size. We don't have, again, the numbers. We're not propped up with stats and stuff this episode. But if you looked at sort of, the balance sheet that Renaissance Re started with, 92?
Yeah, around then.
Would be radically smaller than it is now, right? And so they could get into the game and they could start with targeting a core part of the market that they wanted to address, and then as they've grown organically over those sort of last 20 years, they've really been able to quite radically increase the size of capital that they can put to work. But those firms now have gotten so large that they can withstand undulation in market conditions a bit more.
It's terrifying. Sorry, you said over the last 20 years. It's the last 30 years, Jared. 92.
Goodness gracious.
A really long time ago. I'm myself a member of the class of 92 in a slightly different way. But yeah, goodness me. 30 years. Okay.
So tangent time. So for those, and this is a couple weeks out now, but the most recent Super Bowl, the halftime shows was a really big thing for the U.S. Super Bowl. And this year's halftime show was like, I loved it. It was like this sort of, it was like Eminem and Dr. Dre and all these things. And we were talking about like how amazing this was. We're like, it's not like when they did the Old Timer show, which was like the Rolling Stones. And I was like, oh no, maybe I'm just old now. It is an Old Timer show, but I have graduated to the class of, I actually appreciate the old, and it was that sort of recognition of, oh no, it's not just them targeting me, it's me moving into the target audience of.
I mean, it's crazy because you say like Eminem and how old is Eminem now? He must be really old.
They're pushing 50.
Yeah, because we I don't know how this came up in German class at school. In GCSE German.
Yeah.
That's right, they were GCSEs when I was at school, not O-levels.
Yeah.
Sorry, this is a UK age 16 exam for our global listeners. I remember we did an exercise where we had to work celebrities into statements, and Eminem was sort of, at the top of the list, and he'd just released Curtain Call, I think.
Okay, sure.
Which was his
2003, 2002, something like that.
Yeah, but like he was basically quitting. That was his Curtain Call album, right? And he's kind of, I think I saw him at a festival around the same time.
Yeah.
But yeah, that was a long time ago.
Yeah.
We are old. We're really getting old.
I know. It's
goodness me. Anyway, getting back on tangent. but relatedly, actually, so going back to that RenRe case study, I think they're a really good example of that journey that these reinsurers go on. So when Ren first set up, it was to supply additional property catastrophe capacity to the market. Mm. So people who wanted to insure against hurricanes and this sort of thing needed more suppliers. So that became very much their focus, which required companies like RenRe to have a shareholder base who were willing to go on that journey with them and to understand that basically, 9 out of 10 years, they were going to make a really decent profit because there wasn't going to be a massive hurricane. But 1 in 10 years, there was going to be like a horrible, horrible year where they, lost loads and loads of money, and they'd have like a very negative, return on investment. And you needed shareholders, who were happy with that. And I think what they've done, like many insurance and reinsurance companies over time, is they've found ways to reduce the volatility from their portfolio so that they can be more attractive to shareholders looking for more stable returns and less volatility. And they've done that through a process known as diversification. Do you want to have a bit, take people on a bit of a tour as to what is diversification and why people do it? Yeah, I mean, it's, if we lean into it just looking similar to normal business,
it's that same sort of idea. You want to have it where you're not, if you look at a traditional investment class, you want to invest in a few companies, but you also want to have it where, okay, I have too much money in just tech, and tech kind of moves and up, comes up and down quite drastically as its own category. But if I also have gold or other sort of asset classes, it will allow me to sort of balance out the returns and those peaks and troughs. As you said, it's 9 years really good and 1 year quite bad. But if we have a couple bad seasons, look what happens if 3 of the years are bad. And diversification is intended to begin to offset that as well, because a lot of these things are unrelated. Hurricanes and earthquakes don't really have an impact as to whether casualty claims arise or there's worker comp claims. And so you see the first step is moving out of one core class and introducing things like auto or marine, as we talked about in an earlier episode, or covering agriculture, casualty, all these other additional sort of classes that can emerge from there. But they've more recently continued to evolve, right? And it's accessing new business, because it's diversification not only into different classes, but different geographies oftentimes. Again, if we use Ren as a good example, it was very much United States hurricane business to start. And then it was a bit of earthquake as well, but it was very much U.S.-centric focus. And as they've grown globally, it's like, what is our growth strategy in Europe, and what is our growth strategy in APAC? And it's this moving to diversify both geographically as well as across products to essentially allow that sort of undulation in their returns to balance out a little bit and be a bit more consistent.
Absolutely. And Cordy set us a challenge this week of coming up with the weirdest risk that you could use to diversify your reinsurance portfolio. So have you got one? A good example of a strange claim that might be made?
There's one I saw earlier this week, which kind of touches on two classes of insurance that I think are interesting. So again, reinsurance is just anything that gets insured can be reinsured. So it all flows up into these portfolios. But when I was doing consulting, I was really interested in agriculture globally. And it's not only crop, but it's also bloodstock, livestock, so you can insure animals and everything else. And then you see this climb in like small product insurance. And there's some startups who are doing this, like Trove. I don't know if they're still doing this now, but you could get your phones insured or your cameras insured, and these kind of little things where, is there an audience for headphone insurance or similar?
Said that because I'm wearing headphones.
Yeah, I don't do the headphone thing.
He pointed at me very dramatically as he said that, for those of you just listening.
Do you buy headphone insurance? These
aren't my headphones. So no.
But there was this class of like, could insurance emerge to target an audience who might want this? I saw this article earlier this week where there was a farmer in Devon, probably has all manner of different insurance types, who was assisting the birthing of a calf in a cow, and in the process lost his phone in the cow. And I don't know how he births cat. Is this like he's got the flashlight on?
I think it might be a classic case of nomophobia, which for those of you unfamiliar is the fear of being away from your phone. So probably he was, on the gram.
Oh, do it for the gram, sir. So loses his phone inside the cow. Return the phone. The phone is discovered. He regains access to the phone later on. Again, there's a lot of details I'd be interested to flesh out.
I wouldn't. Flesh out being a poor choice of words as well.
Yeah, exactly.
Goodness me.
But upon the phone coming out, it no longer functions. Must not be waterproof, iPhone 10 Plus. So he makes a claim against his phone not being functioning anymore.
Almost certainly with NFU Mutual.
Yeah.
Because that is our UK farmers insurance brand. Yeah. But anyway.
And they paid the claim.
Brilliant. And somewhere along the chain, probably a reinsurer had a stake in that.
Yeah.
And so when they were doing their claim review and looking at like stuff we paid or helped our insurance,
it rolled into some aggregate policy somewhere, and off we go. The other one, okay, I'll let you do your one. Then I have another one that I wanted to.
Well, my one is also involving animals, funnily enough.
Oh, good.
Maybe it's
agriculture is being
animals make things fun. Well, interestingly, it wasn't an agriculture one; it was a travel insurance policy.
Sure.
So there was a couple abroad who I think we're on the beach or something, swimming away, happily enjoying life. And some monkeys came and stole all of their clothes and basically just like ran off with them and their possessions as well. They left like their phones and their wallets and their clothes just like lying on the sand.
They took the cash though, I'm sure.
Oh yeah. They took the cash out of the wallet and left the wallet. Went to
very clever.
Yeah, went out, bought cigars, and then actually smoking cigars, feeling very proud of themselves. Yeah. Anyway. Yeah. But yeah, this was apparently covered under their travel insurance policy. Monkey theft.
Yeah.
As like a relatively common class of claim. Like what you are. So when they called their insurers and were like, look, we probably don't think this is going to be covered, but some monkeys stole all of our stuff and ran off into the zoo. Into the zoo. Goodness me, how we've been conditioned to see nature that I said the monkeys ran off into the zoo instead of into the jungle.
They went back home.
Yeah, they went back home into their natural habitat, the zoo. It's funny because it's sad.
Yeah.
But yeah, apparently that was covered as well by a claim.
So I think from the strategy side, there's always the opportunity to sort of go into new classes, and you started with this idea of it's always supply and demand. If an insurance company thinks there's opportunities for people to want to get additional cover for stuff, they will do so. I think the consumer space is always an interesting one because consumers don't like buying insurance because they don't think that they're at a risk to, health insurance may be a bit more like I want to make sure that I've protected myself in case I get injured or something. But when it comes to like property and motor and stuff, people think they're better risks than they are oftentimes, which is why I often have like mandates for people to get into different classes and things. But when you look at the diversification, so it's not only expanding into new products, into new areas, but it's also diversifying how they access those. So there's, if you're a reinsurer and you want to grow globally, the really big traditional companies, the companies that have sort of anchored our industry, have done so in the very traditional model, right? They've gone out and set up offices in 50 plus countries, and they have tens of thousands of staff. I think we did some research on this ages ago. And the big brokers are the same, tens of thousands of staff, 50 plus different offices around the world. Because that model really fit how the world was needed to work in a lot of ways. And it was the same with the traditional sort of retailers and everyone else. Everyone had to be on the main street corners and all the stuff to get the footfall.
I feel a Blockbuster analogy coming up.
But it was very similar, right? If you look at how Blockbuster had scaled, it was you needed to be in all the busiest cities and all the busiest storefronts or street fronts. And when people were going by on their way home on a Friday or a Thursday night, they would see it and they'd swing by. And but when we emerged into the Netflix model, it no longer mattered where people lived. It no longer mattered what was the busiest street because it all just shifted to digital. Everyone had access to all of the content immediately. And I think the world has evolved in such a way where you wouldn't go to a shop. Like it's rare now to go to a shop and like for a specific thing that that they should have and them not having it. Like that used to be a really common occurrence previously. Yeah. You go to Blockbuster and there's 30 movie cases of the one that you want, all of which do not have the cassette behind it or the DVD behind it. You're like, the injustice. And you're waiting for someone to return it or similar. And now it's how many, when Netflix launches something that's a hit, like millions streaming it simultaneously in real time, regardless of where they live.
Yeah. It's time to read Walter Benjamin's The Age of the Artwork and the Artwork in the Age of Mechanical Reproduction, for those of you who like philosophy of art. Anyway.
Is it going to touch on NFTs?
No, it's more about what happens when you can basically massively reproduce and serve mass consumers with digital content rather than having to produce one unit of thing every time and how that impacts quality.
Interesting.
But it's pretty old-fashioned and out of date by now. So.
But when we look at how the insurance industry, like the natural evolution of that, the first sort of step that we saw was the introduction of like MGAs, where a reinsurer who wants to write in a new class of business or deploy capital somewhere, instead of saying, well, we need to build an expertise in-house in that, we need to get boots on the ground in that geography, they could deploy partners who would be out there, who knew that space or knew that geography or knew that class really, really well, and they would just be the ones who would provide the ultimate capital that those individuals would put to work. So an extension of their business, and one that they could deploy in a reduced risk. And then if they were really successful with that, they might buy that company up, or they bring them on board, or they might just continue to deploy that on an MGA kind of relationship basis.
I think this is a really key thing that comes up in our consulting days. It came up all the time, but distribution strategy is actually quite defining of the identity of a reinsurer nowadays. So when you're thinking about who you're going to be, you have the historical models that we discussed of especially Swiss Re and Munich Re, as the sort of big two Europeans, that to some extent other reinsurers have begun to replicate. But actually a lot of them are looking at this space now and going, do we want to have 50 plus offices around the world? That's expensive. Do we want to have tens of thousands of staff? That's very expensive. Is there a way we can access original risk in a more efficient way, whether that's, as you say, through MGAs, whether that's through providing backing to software-based sale of insurance and then providing reinsurance capacity fairly automatically off the back of that. So it gets really, really interesting as a reinsurer to work out how to spread your risk out into these portfolios and to access risk as capital. Mm-hmm. But equally, I think this is the bit that maybe fewer people will know about, again, especially if you're new to reinsurance on this podcast. The whole same set of questions are being asked the other side of the chain. So not only is it reinsurers, how do you access risk? It's reinsurers, how do you access capital as well? And capital providers, how do you access reinsurers to access risk to some extent? So there's a whole class of product called ILS, or insurance-linked securities, which is one means of providing firms that have lots of capital, could be pension funds, could be all sorts of things, with a way of getting exposed to insurance risk. But one of the most common ways is to provide equity to reinsurers as a way of getting exposure to insurance and reinsurance risk. But we've found one of the biggest contributing factors to the softening of the reinsurance market over the last 10, 20 years has been a real increase in the amount of capital available on the ILS product side of things. When we talk about ILS here, we're talking about things like catastrophe bonds, so bonds that hit or bust, basically pay out if a disaster happens. Parametrically triggered products, like if wind speed in this zone goes above a certain amount, this product pays out to the insurance company or similar. And these sort of things now, I think, provide about 100 billion of capital in terms of scale out of the 500 billion of capital that's available across the industry. So they really have grown as an alternative way of, to some extent, disintermediating the reinsurers as a alternative.
Yep.
They struggle a bit, I think, when it comes to longer tail lines, because the investors typically don't want to put their capital in for many, many years, whereas...
Because it can get trapped in things, can it?
Exactly, yeah. I mean, I think they're more sort of debt instruments that they just want to be able to get out of, whereas the equity model of we're a reinsurance company and our balance sheet is your protection is more well prepared for this. We won't find out if we're going to have a claim until 7 years' time, once all the lawsuits are over.
Well, and I think we've spoken previously about this sort of following the really best in class underwriters, and I think these additional capital providers, pension funds, etc., they're very interested in being like, well, we want to deploy X 100 million into a thing, like, but who are best in class? Who are the firms that have access to risk? And this is where it's become a vehicle by which firms are beginning to deploy, that they can sort of market to that class of investor and say, this is the pool of risk that we have access to and that we're reinsuring. If you give us more of this capital, we'll deploy and build more of this. This is our returns. And that's becoming a really appealing thing that a number of companies, again, we've been using Ren a lot this discussion, but it's quite appealing because they can sort of say we have a global reach, we're doing all these different classes, this is how we've returned our capital previously, and building in sort of another form of income by doing this. And so now it's a core business, new areas, and with MGAs and things, asset income or investment income on behalf of other parties. Like, so they're beginning to diversify the income streams that they have. And again, it's very similar to traditional businesses where income stream one is the core product, and then you start going, okay, what else could we do adjacent to this? And you sort of just inch up and around, and you try to improve access and distribution. So it's
I think it's part of a recognition of this opportunity to debundle the entire chain, right? What a buzzword, debundling. But in the sense of, in insurance and reinsurance and capital, at the end of the day, are kind of a bunch of services. So right from the means of selling and marketing the original policies to claims payment services to advisory and risk management, all that sort of thing at one end, to capital management, to pricing, to all those sorts of things, that can happen in various points of the chain. And they're all chargeable services in some ways, and some of them get charged to the customer, some of them get charged to the capital. But you're right, you see companies like Ren and others making fee income, risk-free fee income, where actually they can put other people's capital on the line, with the the aim of using their underwriting expertise to generate a return for those investors, directly, rather than actually putting their own balance sheet on the line, or both a lot of the times. I think one of the early examples of this in the market was Hiscox set up a syndicate, or an extra bit of capacity called Kiskady, where it was like you can put it on the Hiscox paper, so the Hiscox balance sheet is your assurance, or you can put it on the Kiskady paper, which is some third-party investors who want to follow the fortunes of Hiscox and use Hiscox's underwriting nous. It's a great word, nous, to make sure that they're taking on really good risks, but without having to, as the investor who wants their capital to be exposed, set up a equivalent capability of Hiscox in terms of claims payment, capital management, underwriting, servicing, etc.
Yeah,
it's exciting.
Well, and I think setting these companies up from scratch, there's a huge amount of component parts, and so when you look at how you get into that space and how do you sort of gradually do it without sort of a injection of, some companies have just like IPO'd to get started, right, kind of model, is you can start by just underwriting and using someone else's paper. This is a very common MGA approach now, where we have a few underwriters who have an expertise in a class or a geography, and you give us some support, and then eventually they maybe go raise some money proving how they've underwritten their business and they're successful at that. But still, this reliance and support from who's going to be the claims engine and department, who's going to do all the accounting and all like the regulatory filings, and there's all manner of complexity. So the barrier to entry is quite high and sizable, but there's so much premium and there's so much income that can flood into this space that you still see people going, yeah, well, we can go out and raise several £100 million and build this company up. So it's not a model you can't do, right? There's like the step-by-step approach, and there's the sort of pile in all at once kind of approach, and they've both been done successfully.
What would you call a reinsurer if you set up a new reinsurer? Because that's always made me laugh. Do you know what I mean? Because you go around, all the Lloyd's syndicates have different names, that have come from somewhere. Some of them are very weird. But likewise, some of the new reinsurers that are popping up, I always wonder who has a say. I remember the funniest one. So I used to work for a syndicate called Acapella, briefly, and as I understand it, a lot of the reason for that name was because if you begin with the earliest possible letter in the alphabet, you appear at the top of the list in a list of who's attending the conference, or that sort of thing. So I think it was very close to being called Aardvark Insurance, but they decided that was not a good look, and Acapella was the next word down, sort of in the dictionary. But how would you name your reinsurance company?
Meta-Re.
Yeah, that might be taken.
Yeah.
Might be taken.
I mean, always looking for a lawsuit.
Yeah.
That was the other story I wanted to tell, and I'll maybe end the episode on this. I was also reading there's been this spike in insurance claims from people getting injured with VR and breaking things with VR. So there's this woman who was playing some zombie game, and the zombie jumped out on the VR, and she chucked her controller at it and shattered her TV. And the insurance company paid the claim on this. But it's like there's a bunch of videos on these things. I think it's VR to ER is the thread. of people getting injured. But the insurance industry having to sort of grapple with, like, if you just intentionally smash your TV, they're probably not going to pay for it.
Yeah.
But like, if you make the claim that you were scared by a VR zombie and in your own self-defense shattered your TV, that's something you can protect against now. So diversification, get into that space. That's a growing category, I think.
Yeah, goodness. And there must be some personal injury claims
Oh,
from this
tons.
as well, right? Like where you injure yourself or somebody else. A poor
They'll run
passing
into the doors
family
like-
member.
It's fabulous. So after you visit superseed.com today, go to Google search VR to ER for some videos that will make your afternoon very enjoyable, I assume.
The Superseed will not be held responsible for any content
Yeah,
you find
exactly.
outside of superseed.com.
Exactly. Yeah.
Brilliant. Well, I look forward to doing a VR episode with you at some point.
Yeah. And I think this is going to be another one, sort of one of many on sort of reinsurance strategy. I think there's so much happening in this space and there's so many things we'll want to touch on. So this is, again, just a glimmer into some of the elements of this, but it's been a really good discussion. Good seeing you.
Yeah, likewise. And I look forward to audience contributions as to how we can eventually build that ramp up Mount Everest. Send in your ideas to how to build Mount Everest ramps at superseed.com, and I'm sure it will reach us somehow.
And please feel free to share us funny videos of people hurting themselves with VR as well.
Schadenfreude. Anyway.
Yeah. Cool. Perfect. Thanks, everyone. Thanks for listening.
See you next time.